Welcome back to your online tutor, the one place where we turn questions into answers. Today we're looking at a grade 10 accounting paper and we'll go through it together. So if it's your first time doing accounting and you're trying to figure out why you chose this subject, do not worry, you are in the right place. Okay, if you have any questions that you have throughout our learnings, during this question paper that we work together, any other additional non-related accounting questions, please do leave them down in the comment section. Okay, so we have question 1. Let's read it together. Concepts 1.1. Choose the correct answer from the options provided. Write only the letter next to the number on the answer sheet. Example 1.1.1D. Okay, so we've got our first one over here. And this is a telephone is a account. Where's our highlighter? So a telephone is a account. Let's go through all of them together. Okay, so balance sheet. What does balance sheet give us? A balance sheet gives us, let's try make rooms. Let me put it at the bottom instead. Yes. Okay, so let's write it in black. Okay, so we're saying 1.1.1. The first option is a balance sheet, yes? So a balance sheet basically gives us our assets, our owner's equity, and our liability. Okay? Very similar to our accounting equation, which says assets is equal to owner's equity plus liability. So this is your balance sheet. Okay, so let's go back. So does it make sense to say telephone is a balance sheet account? Does it make sense to say telephone is an asset? So let's go back. Let's take a step back. What is an asset? An asset is something you own. Anything that you own. Okay, owner's equity is the value of the company. A good example of this is that if you look on the JSC or shares, you know the value of, let's say, MTN. This is a wild example. I have no idea how much MTN shares are worth at the moment. Is, for example, 100 Rand. This is the value of your company, your owner's equity. Not necessarily, but I'm trying to help you understand, okay? But owner's equity could be more broad. Liability is something that you owe. If you owe somebody something, you have a liability. Okay, so do you own a telephone account? So when you pay Vodacom, so what is telephone accounts? Let's take a step back. Telephone account, for example, your contract with Vodacom. So if you have a phone, let's say you have an iPhone and you took out a contract with Vodacom and every month you pay 500 Rand. This is your telephone account, for instance. So is your telephone account something you own? No. So you don't own 500 Rand that goes to Vodacom every month. So it's not an asset. Is it something that will be used to measure the company or the value of the company? Your telephone, something that you're paying out. Do you think that contributes to the share price, for instance, of the company? No. And is it something that you owe? So yes, in inverted commas, you do owe this telephone account, but it's not a debt as such. So you do owe it, yes, in the sense that you have to pay it every month, but it's not something you owe, so it's not a liability. We'll touch on what an example of a liability is. So let's just write it here just in case we don't have an example in one of the questions. An example of a liability is a loan. So the bank gave you money and they need their money back. Thus, there is a loan. You owe the bank their money back. Okay, so it's none of the above. So it's not a balance sheet item. So A is completely out. Our next option, is it an asset? So already touched on an asset. And we've both said that it's not an asset. It's not something you own. You don't own 500 Rand that you pay every month. No. You own your phone, yes, but not the 500 Rand you pay. Is it an expense? So an expense is something that results in an outflow of money. So this definition is not exact, but it's a very summarized definition to make it easier to understand. So outflow of money. Every month you take out 500 Rand. Every month you're losing 500 Rand. So it's most likely an expense. But let's go through D just in case it might be D. Is it an income? So what is an income? An income is something that results in an inflow of money. So you have this contract with Vodacom, for instance. Does Vodacom give you, the customer, 500 Rand every month? No. So you don't get 500 Rand every month. Vodacom isn't just like, everybody who has a contract with me, let me just give you 500 Rand. Yeah, no. No. Okay. So the correct answer here is C. A telephone account is an expense because it results in an outflow of money. Money leaves your account every month. 1.1.2. People who owe, let's grab our highlighter. People who owe the business money are known as, again, let's go back to it. We said from our balance sheet, something that you owe is a liability, yes? So if you owe this thing, what will be in your liability section of your balance sheets? That's what I want you to be thinking now. Okay, so let's go through the first one. Will you see debtors? Do you owe debtors money? What is debtors? So let's go through our definition of debtors. Very summarized definition. You are more than welcome to look on the internet, Google, accounting dictionary, but this is a very summarized definition. Debtors. Debtors are people that buy on credit. In very simple terms, that buy on credit. So, for example, you love clothes. You are a fashionista. You are Insta baddie. So you buy your clothes on credit from, let's say, can't think of a clothing shop, H&M. You buy your clothes on credit from H&M. You are a debtor. You don't pay cash. You don't use your card with money that belongs to you. You use the bank's money. Use a credit card, for instance. So, not a credit card, no. Terrible example. You use a store account. So, good example is for Sheeny, which has a store account. Use a store account. So, you are a debtor. People that buy on credit. Creditors is then us. We buy on credit. So, not us, but yes. So we're also buying, so perspective here. So debtors is people that buy on credit to the business, our customers. So it's our customers that buy on credit. Okay. And then creditors is basically people we buy from. So we buy from on credit. So our creditors, for instance, would be, and again, credit gives it up, credit, debt, they owe, creditors, credit doesn't exactly say owe, but creditors buy on credit. Our creditors, for example, will be wholesalers. So we buy from someone else. Pick n Pay doesn't necessarily make all its products themselves. So Pick n Pay has a range of products. And for example, Milk or Clover they'll buy from Clover's factory, for instance. So their creditors are Clover because they will not buy 500 cartons of milk cash. They're a big company. They'll probably buy it on credit. Bankers, people who bank. And wholesalers, people where you buy in bulk. So people that allow you to buy in bulk. Buy in bulk. So people who owe the business money, so bankers is definitely out. It's not a banker, no. Trying to think of the definition of a banker. It's not coming to head, but it's definitely not a banker. Not a banker. Let's cross that out. People who owe the business money are known as debtors. So they owe the business money. Owe the business money. Again, perspective. Is it from or is it to? Owe the business money. Creditors is people we owe money. So it's most likely debtors. Because whole essays are just people that allow you to buy in bulk, like macro, for instance. Macro. Okay, so your correct answer is A. People who owe the business money, owe the business, so to the business. People that buy credit to the business, money, and we buy from, so debtors. Sorry, I'm just rereading this statement. So it is debtors. People owe the business money. These are our customers. Our customers owe us money. But people we owe money are creditors. So when we buy out, let's draw a little diagram just in case it's not clear for anybody. So this is us. And let's give us a name so it's easy to work with. Let's say we are Woolworths. Okay? People that buy from us is our customers. If our customers buy on cash, then of course, they buy on cash, that's fine. But if they buy on credit, then they are debtors. Right? When we approach a wholesaler, we buy on credit. And our wholesaler is then a creditor. Our creditors. Okay. So debtors, they buy from us. And then wholesalers, we buy from our wholesalers. The arrows can even go the other way because the cash is coming here. So I think it's better this way. The cash is coming here. So the money is coming to us, and then we then take the money, and then we buy from our wholesalers on credit. Okay. 1.1.3, which of the following is a non-current asset? Let's go through these together. So the first one is land and buildings. So what is non-current asset? Let's start there first. Non-current asset is any asset that cannot be sold. Be sold in less than 12 months. So if it can be sold in less than 12 months, it's a current asset. Okay? So land and buildings. The land and building, so the building you are currently in, for instance, the school building you're in, will they sell that in less than 12 months? Most likely not. So this is a non-current asset. Okay? Trading stock, for instance, they are most likely going to sell your trading stock in less than 12 months. If you're a business that sells jewelry such as Lovisa, you're trying to sell your jewelry as quick as possible. So in less than 12 months, this is a current asset. Sorry. Sorry about that. Vehicles, it's very hard to sell vehicles. So vehicles could be considered a non-current asset. Even car dealerships, they don't sell vehicles very often. Okay, so it's like a non-current asset. But if you sell vehicles often, then that's trading stock. So that's a different thing. Okay, equipment we usually keep for a long period of time. So we're not trying to sell equipment if we have equipment in our business. We're not trying to sell ovens if we're a bakery. in less than 12 months. So this is a non-current asset. So answering the question, which of the following is not a non-current asset? And your answer will then be 1.1.3b. Okay, let's move on to 1.1.4. Profits generated by the business will always increase. Let's go through them. Owner's equity. Remember, owner's equity is the value of the business. Assets is things we own. Creditors are people we owe because we bought on credit. And cash is cash. Okay, so cash profits generated by the business will always increase. Our correct answer in this case is owner's equity, because owner's equity has retained earnings, and this is basically profits. This is where your profits stay. So this is where dividends are then paid out. So dividends are paid from profits. So profits of the business will always increase retained earnings. Retained earnings is like the little bucket that keeps your profit. Okay, so your correct answer is A. 1.1.5, which source document can be used to record goods purchased on credit? So you've got a receipt. Okay, then you've got a duplicate invoice, original invoice, and check counterfoil. So check counterfoil for any check transactions. Original invoice is if we bought something. We bought on credit. Duplicate invoice. So have you ever seen when you go to a shop, they will give you the original invoice and they will keep the copy of it. Okay, same thing. This, but invoice refers to credit. Duplicate invoice then is if someone bought from us, so our debtors bought. So debtors do buy on credit, but I'm just going to put in there on credit. So your debtors copy here, and your receipts then is anyone who bought. So source documents used to record goods purchased specifically on credit. So which notes or which documents talks about credit? And here you can see it's either B or C. So now we need to see perspective. Is it from your creditor's perspective or from your debtor's perspective? So source document used to record goods purchased on credit. We bought on credit. So your correct answer is C. So if we buy on credit, we'll get an original invoice. Whereas if our customers buy on credit, we have the duplicate invoice. Source document used to record goods purchased on credit. So we buy on credit, we get the original one. But other people buy from us, we get then the duplicates, they get the original. So we'll stay with the duplicates. What stays with us if we buy on credit is always our original invoice. So C. 1.2, analysis of transactions required. Analyze the following transactions according to the example provided in your answer sheet. Assume that the bank has a favorable. So let's go through this very quickly together. What does this mean? Favorable balance bank. So our bank has a debit and has a credit. Our bank will increase on our debit side and decrease on our credit side. So if it has a favorable balance, it's where things increase. So on your debit side at all times, unless indicated otherwise. Okay, so let's draw this out before we get started. Okay, so your first column would be source document. Your second column will then be Okay, so let's go through this together. So you've got your source document over here. Source document, which you covered in 1.1.5. Then you've got your general ledger. And then you've got it increases on your debit side, credit side, depending on what it is, or credit side. And then you've got your accounting equation. And here you've got your assets, owner's equity, or liability. Let's start with our first point. So the owner did an electronic transfer of 180,000 to the business current account to increase his capital contribution. How would we record this? Okay, so first of all, what is our source document? We would find this because it's an electronic transfer. We do not know about it until we see it in our bank statement. So we've got our bank statements as our source document. So bank statements will tell us where it went. So 1.1.1, we've got bank statement. There's no proof anywhere else that he did this. But because he did an EFT, electronic, from his accounts to bank's accounts, once we see the bank statements, we'll see that he did do it. Okay, so what is debited and what is credited, which accounts? Our bank is obviously increasing. So our bank is increasing, and bank is an asset. Assets increase on the debit side. So increase on the debit side. And then what else? His capital account. Capital account. So capital is an owner's equity account. Owner's equity increases on the credit side, and that's why it's on credit. Okay, so you are then saying, this is an asset. Okay, so we are then saying increase asset of how much? How much did he transfer? 180. So plus 180,000. Increase owner's equity by how much? Increase the value of the business, 180,000. There's nothing that relates to liability, so liability is 0. Are we happy? Let's move on. 1.2.2. 1.1.2, sorry about that. Purchased a computer from DT Technology, issued a check to the value of 3,800. So amounts are always important, so we highlight our amounts. Then we're saying, what did they do to this amount? They purchased, so it's money going out. Outflow. We're not told it was on credit, we're told it was a check, so we know this is cash. And cash always links to bank. So we know our bank, because it's an outflow, bank is going to be decreasing in value. Bank decreases in value on the credit side. But what will increase? We got a computer, so it's an asset. Okay? And an asset will then increase on your debit side. So here you go, you've got a credit and you've got a debit. So a computer could then be considered an equipment. 1.2.2, where will this be shown? So check, they said they used a check. So we check. Then we're saying, what did we say will be debited? Our equipment will be debited. Equipment. And equipment is an asset. Our assets are increasing. We're getting more equipment, but our bank is also an asset. Our bank decreases because we are paying out. We have less money in the bank. We spent money. Okay? So our bank decreases on the credit side with an amount of 3,800. So let's think about it. We're saying bank is also an asset. So it's only affecting asset accounts. Okay? So you've got your plus for this asset that's going up, and you've got your minus for this asset that's decreasing of how much? 3,800. 3,800. Does that make sense? So you see here, Asset, this was where your asset was, asset increase. Owner's equity increase, there we go, and nothing for liability. Here it's only assets account. Therefore, there is nothing for owner's equity and nothing for liability. Okay. 1.2.3. 1.2.3. We told that we sold goods uncredited to our Pule for 2,800, markup on cost of 25%. So we sold goods on credit. Remember, perspective is important. So if we are selling goods, we give customers the original invoice and we are left with the duplicate invoice. So our source document then is duplicate invoice. We are selling goods. So anything that has 1.1.3, yes, sold goods. Anything that involves sales has two accounts. We've got your sales and you've got your cost of sales. Always, always, always. This is important. Please write NB next to it. You'll always have two accounts, sales and cost of sales. Okay? So your sales will increase and your cost of sales will... Okay, wait, let's get into it first. Okay. So we're saying we sold goods. So let's start with the first one with sales. We sold goods on credit. Okay. So credits then always pulls out either debtors or creditors account. And because we sold goods and we didn't buy goods, we want to say debtors. Debtors control specifically. And then credit sales. But if it was cash, it would be bank. So let's write the first one down. So A, we've got debtors control. This is an asset account. So even though they didn't give us the money, it's on credit, we're waiting for them to pay us. They took the goods and we're waiting for them to pay us. Because we expect for them to give us this money, it's our money. We own the money. We own the money. Okay, so the 3,000 Rand for that they're going to give us in 3 months' time is basically ours. We can account for it because they took the good worth 3,000. So it's our money that they haven't paid us yet. It's like borrowing someone your calculator. Just because they borrowed it doesn't mean it's no longer yours. So they have it. They have the whatever they bought, but the money belongs to us. They must give us the money. It's our money. Just because they have it doesn't mean it's no longer ours. So they have the money. So they have the money that must come to us, but the good can stay with them. Okay, so debtors control is an asset. Okay, and it's increasing. So we're increasing how much we have in our books. How much money we'll have in the future. That's debtors control, basically. Money in the future. Money we'll get in the future. So it's increasing money. Money we don't have now, but it's increasing our money because we had a sale. And we're crediting sales. Sales increases on the credit side in owner's equity. So owner's equity takes into account two things. It takes into account income and it takes into account expenses. Okay, so sales is an income. And income increases owner's equity. So if we want to put this down, what was the full amount that we paid? The full amount was how much? 2,800. We are increasing assets, increasing owner's equity. 2,800. We then have cost of sales. So cost of sales of 2,800. Okay, so let's put that down. So part B, cost of sales. Cost of sales is an expense account, cost of sales. Okay, we've got cost of sales and we have then got trading stock. Trading stock. Let's think about it. So cost of sales is basically, as the name gives it up to you, so as the name says, cost of sales, the cost of our goods. So what was the cost of our goods? This is not the cost of our goods. This is your selling price. Now we need your cost price. Okay? And trading stock. What is the good worth? So the cost of your trading stock. So trading stock is decreasing because we no longer have, what did we sell? We no longer have the goods we sold. So we're not told what the good is, but we no longer have it. So your trading stock accounts, let's just make this longer. Trading stock accounts is decreasing. We know trading stock is an asset account. So your assets are then decreasing. So we can put that down. But first we need to determine what is our cost of sale amount. What is our trading stock cost of sales amount? So we told the amount is 2,800 and we've got a markup of what? 25. 2,800 multiplied by trying to put it in my calculator. Okay, so we've got 2,800 multiplied by 25 over 125, and this gives you an answer of 125. This gives you an answer of 560. Okay, so then we're going to say 2,800 minus 560 to get our cost of sales, and this will give us an amount of 2,800 minus 560, 2,240. So we've got cost of sales amount of 2,240. So this is your markup here, and this is your markup here. So we're saying selling price multiplied by markup percentage over 100 plus markup percentage. So this is equal to your profit. Okay, so we know selling price minus profit will equal to cost price. There probably is a simpler formula. When I think of it, I'll let you know. I think I took the longest route to arrive at the answer. But if you can think of it, please feel free to jot it down. Okay, and we get our cost price of 2,240. So let's take a step back. We're saying this is trading stock. So we're saying trading stock is decreasing. Our asset is a trading stock. Is decreasing by 2,240. Perfect. But we're saying cost of sales is an expense account. Cost of sales, we paid this amount. We paid. So cost of sales is an expense account, and your expenses are increasing in value. Okay, your expenses are an owner's equity account. Therefore, owner's equity is decreasing by that amount. So owner's equity increases by income. There we go. Increase by income and decrease by expense. So we're going to say minus, because it's an expense, 2,240. Does this make sense? And the difference between those two is then your gross profit or your profit. Tell me this makes sense. So this is the only tricky one is sales. Whenever you get a sale transaction, you'll always have two parts. You'll have your sale first part and your cost of sale. How much is your selling price and how much is your cost price? Always two transactions. And either it's like in this, debtors control. This was for credit. But if it was on cash, it would be bank. So this will stay like this and this will stay like this. The only thing that will change is here, depending on if it's on credits or cash. Perfect. 1.2.4. If it doesn't make sense, please leave a comment in the comment section. 1.2.4, purchase goods on credit. Purchase goods on credit from NT traders, 6,000 less 15% trade discount. Okay. So we bought goods on credit from, so perspective is so important. So we're not buying to, so we're buying from. So we take our money. Sorry, I'm looking at the wrong question. Here. From. We take our money and we go to NZ traders and we buy goods. So we, the customer, we get the original invoice and the company NZ gets the duplicate invoice. So also documents then is, so 1.2.4, original invoice. Does this make sense? I hope it does. Let me know if it does. Leave a like button if it does. Okay, so we've got our original invoice from NZ traders of 6,000. Okay, but we didn't pay the full 6,000. We paid 6,000 less 15%. So we've got 6,000 multiplied by 100 minus 15. Percent. So if you put that in your calculator, multiplied by 15, you should get an answer of 5,100. Okay, so let's think about it. We bought goods on credit, so we are getting goods. So we say goods or a trading stock, because that's what we refer to goods as. Okay, so we've got trading stock, which is increases on the debit side. So we've got trading stock, which is an asset, which is increasing. So while we still added, we can go put our amount, 5,100. So plus 5,100. What else do we have? We told we bought on credit. So NZ traders is then our creditors. So then we have creditors control. Creditors control. Our creditors increase on the credit side. Creditors increase on the credit side. Yes, the name does give it up. Okay, this is a liability. We owe our creditors the money. It's not an expense. We're not just paying. We owe them the money. Okay, so creditors increase on the liability side. Okay, so we can go to our liability part of our equation and put plus 5,100. Okay, liabilities are increasing. We are increasing how much we owe. Plus 5,100. Let us continue. Our table keeps disappearing on us. Okay. Our next one, 1.2.5. 1.2.5, received a check from R. Pule. 1.2.3, so here's it over here. Received a check. This was sold on credit, so we never received the cash. We're just told, oh, you'll get your cash, just not now. Okay, from our Pule after deducting a 5% discount. Okay, so let's calculate the amounts first. So the amount is 2,800 over here, multiplied by 100 minus 5%. And this gives you, I'm putting it in my calculator as well. Please put it in yours. We get an amount of 2,660. Okay. So we received this amount. We received amounts. Where does it go? Where does the money go? What holds our money? Bank. There we go. Bank. Okay. So 1.2.5 received money. We said duplicate receipts. Duplicate receipt is our invoice. We've got our bank. Bank is an asset, and our bank is increasing. We said it's going to increase by 2,660, so plus bank. Okay. And we are decreasing debtors control. They no longer owe us. So here, 1.2.3. So sales, you won't account for again. Sales is done. We got that income. We're happy with that. But what is going to change is this debtors control over here. So debtors control is going to decrease because they no longer owe us the amount. So we've got debtors control. Which then decreases. Debtors control is an asset, and your assets are then decreasing. So minus 2,660. Okay. Then we've got the discount amount. Then we've got our discount amount. So we've got the discount of, what's the difference between 6,000 and 5,100? We've got a discount of 900 Rand. Is it 900 Rand? Am I getting confused? It's not 900 Rand. I'm looking at the incorrect amount. Okay, so difference between 2,800 less 2,660, and this should give us 140. Okay. So we've got debtors control, which is decreasing because we no longer owe the full amount. So debtors control, so that's why it still needs to be accounted for, because the full debtors control was 2,800. Okay. So 140, 2,800, and 2,260 will give you the total of 2,800. And what do you credit? Discount. Discount allowed. Okay. Debtors control again is decreasing by this amount. So your asset is decreasing. Your discounts allowed is an expense. Okay, so we are decreasing of 140. Let's look at the next one, 1.2.5.6, sorry. A debtor who owes the business has been declared insolvent, meaning they cannot pay us our money. He transferred, but he did have some money left to transfer. So he transferred 450 electronically, so our bank statement. Okay. And 25 cents of every rand he owed should be written off. So they like things like this because it's a little tricky, but it's fun. Okay, so he owes the business money and has been declared insolvent. But he did give us. So let's start with the first thing. He paid us some money. Let's start with the money we receive. We like to receive money. Yes, yes. Okay, and he transferred it electronically. Electronically, we're looking at bank statements. Okay, so your bank statements will then show that. So we're saying bank statement for electronic transactions. And we're saying bank statements, we received the amounts, so the amounts that he still had on him. This is an asset, so assets are increasing. Did they tell us how much he received? He transferred 450 electronically, so plus 450. And then what else? What else? Debtors control. He was a debtor, so we know he paid on credit. But also debtors are reflected in which account? Debtors control. So therefore, we're saying debit bank, because our bank is increasing, and we are then decreasing debtors control, how much he owes us. Debtors control of how much? Minus 450. Debtors controls are now the asset accounts, which is then decreasing. Happiness. Okay, second part of it. Please do this also in your thing so you do not miss out on marks. Second part, 25% of every rand you owed should be written off. How do we get to every rand you owed? So he transferred, let's think about it. He transferred 450 electronically, and 25 cents of every rand he owed should be written off. So I'm putting it in my calculator. I'm saying 450 is what we have. We're going to say what we want is 25%. Perfect. Okay. So I had to think about that as well. So we're saying 450 is what we have. So what we are given. We're going to say 450 multiplied by what we want, which is 25. But 450 does not represent the full amount. Remember, he did not pay the full amount. He only paid what he could. And he only paid 100, which is the total, minus 25. So he paid 75% of the total. And this then gives you an amount of 150. So we're saying, let's read it again. A debtor who owes a business has been declared insolvent. So meaning the debtor doesn't have a lot of money left on him. He transferred what he had of 450 electronically. And 25 cents of every rand. So 25 cents is basically this, yes? So it's like you're saying 25%. So 25% your owed should be written off. Okay. So what isn't written off is then 75%. So 450 is the same as 75% of what he owed, the total of what he owed. Okay, so if we put in our equation, what we are given multiplied by what we want 25% over then what we are given, which is 75%, and then we get 150. Okay, if this doesn't make sense, please leave a note in our comment section. So we've got debits, bad debts. So bad debts are increasing. Bad debts is an expense account. Expense decrease our owner's equity. So therefore we're saying minus 150. Okay, and we're saying bad debts will also decrease because bad debts will never receive our money. So the money we say was ours at the beginning is ours. It's not mine. Ours anymore. So bad debts is also decreasing. Bad debts is an asset. Debtors control. Debtors control is an asset. And therefore, minus 150 over there. Okay. So we've reached the end of today's accounting equation. If something does not make sense, please leave a note in the comment section. Let's go through that together. Okay. Thank you for watching. Let's stay tuned for the next one.